The fact that the price of gold held up so well and now obviously reached all-time highs on a closing basis suggests that people don't believe that these interest rates can stay that high that long for gold, as you're pointing out, gold equities. But I don't take any joy out of the fact that it's not been replaced with a strategy. It's just that, okay, hey, mission accomplished. And why don't markets go off and have a bit of a rally?
Gold is trading around $2,030, having pulled back from its intraday high of $2,042.09. The fluctuation in gold prices is attributed to the Federal Reserve's monetary policies, geopolitical uncertainties, and the ongoing trend of de-dollarization, which collectively continue to support gold prices. Axel Merk provides insights into the gold market, analyzing the impact of Federal Reserve policies and prevailing economic conditions. Axel discusses the positive outlook for gold prices and potential opportunities in junior mining companies, offering insights into the current investment landscape. Despite the Fed's hawkish remarks, introducing uncertainties about early interest rate cuts, gold demonstrated resilience by closing the year at $2,000 per ounce for the first time, marking its 8th consecutive annual gain. The precious metal rose by 13.10% in the past year, maintaining its positive trend and advancing in 20 of the past 24 years, or 83% of the time. Merk acknowledges the speculative risks, but suggests that these junior companies might outperform gold prices in the evolving economic environment. The GDX Gold Stock ETF, a significant player in the market, showed a remarkable surge of 63.9% during gold's last upleg of 26.3% that concluded in early May 2023. This indicates a substantial 2.4x upside leverage. Historically, major gold miners in GDX tend to leverage gold by 2x to 3x, exemplified by the ETF's performance in the mid-2020 40.0% gold upleg, where GDX soared 134.1%, amplifying gold's gains by an impressive 3.4x. Pierre Lassonde predicts that, with gold stocks currently trading at 50% of their value, 2024 is anticipated to be a catch-up year for these stocks. Before you watch Axel Merk's interview, subscribe to our channel and give this video a big thumbs up.
Well, gold just is. Gold doesn't change, right? And so the world around it changes. I would say it's been remarkable how well the price of gold held up when the Federal Reserve pushed up interest rates as aggressively as it did. Keep in mind, right? Gold doesn't pay an interest. It's this barbaric rally, and it's competing with cash. Now, if you get rewarded for holding cash, then cash is worth more over time than the price of gold is. Then the price of gold will go down. The fact that the price of gold held up so well and now obviously reached all-time highs on a closing basis suggests that people don't believe that these interest rates can stay that high that long. One way to think about it is, I always think there are 3 types of gold buyers. There's the one that we tend to talk about. That's the one concerned about the purchasing power of the dollar. The second one is the one that's investing in gold because of its diversification criteria, because the long-term correlation to equities is about 0. In 2022, that didn't work so well. In 23, that worked better. Doesn't mean the correlation is always 0. And then the third one is the speculator that just loves to jump on a good trend. That investor focused more on the meme stocks, but I have little doubt if gold had a big rally that those guys would come back. And so from a diversification point of view, I think gold is pursuing its role as good as ever. The question really is on the purchasing power side of things, is gold expensive or not? I do believe, because we've moved beyond the higher for longer environment, this is an environment that's very favorable for the price of gold, with that risk that because it held up so well, that the upside may be more muted than many gold bugs might imagine. If you shift a little bit to the gold miners, the junior mining companies that are really credit plays have really suffered from the higher for longer environment. And so what could well be is that the gold miners are going to significantly outperform the price of gold as we're moving into an easier environment. That doesn't mean the price of gold will go down, but it means that that gap, so to speak, that there's going to be a catch-up. It's a highly speculative field, by the way, so I'm not telling people to pile in money that they can't afford to lose. Anybody who's who's invested in that sector should be aware that this is not investment advice. This is just what I think might happen. I think one of the problems of the big miners is that they've been so profitable, because that makes them less levered to the price of gold if they produce a ton of cash, and they have been underinvesting in the industry. So that's been their biggest problem. And then the more you go down, of course, the cost, especially during COVID, has been a major challenge. But it has been the hostile financing environment that's put them very much at risk. And what's happening now with the price of gold moving higher, a lot of these junior miners have a lot of gold in the ground. But the permitting takes forever to get that out of the ground. And so, yes, the quote unquote leverage the price of gold goes up dramatically. But it doesn't help them if they can't find ways to finance the projects. And until very recently, it was only the best of these players that were able to raise money. And so everybody else was scrambling. And of course, with the majors just waiting for these junior guys to get even cheaper, we'll probably see more merger activities in the lower tiers. Even the junior players, there have been mergers. Sometimes they're just putting two problems together into one problem, and now they're bigger, and so now somehow they think it's going to be more valuable.
In a remarkable feat of economic policymaking, the central bank seems poised to steer clear of a recession. The Federal Reserve recently signaled the conclusion of an unprecedented series of rate hikes aimed at curbing inflation, which dropped to 3.1% annually in November 2023, from its peak of 9.1% in June 2022. Drew Mattis, chief market strategist at MetLife Investment, anticipates that the Fed will implement 6 rate cuts in 2024 in response to a gradually spreading recession in the U.S. and an expected deterioration in the job market. Axel Merk highlights the current economic situation, pointing out that it is characterized by the most forecasted recession ever. Meanwhile, the Federal Reserve Governor Michelle Bowman, who had previously held a consistently hawkish stance, recently shifted her view. She now sees U.S. monetary policy as sufficiently restrictive and is willing to support potential interest rate cuts as inflation eases. Merk's criticism of the Fed centers on the higher-for-longer tactic, denoting the prolonged maintenance of higher interest rates. He contends that this approach is not a sustainable strategy, but a short-term one. Let's get back to the interview.
I'm just pausing here. Did the Fed decide to resign and put in rules in place? That would be a really nice Christmas present. No, it's not a Christmas present, because it's not about what the Fed will do today. It is what the strategy is at the Fed. And I've argued for a long time that quote unquote higher for longer is not a strategy, it's a tactic. Now, the fact that higher for longer is coming to an end, yes, it's a positive for gold, as you're pointing out, gold equities, but I don't take any joy out of the fact that it's not been replaced with a strategy. It's just that, okay, hey, mission accomplished, and why don't markets go off and have a bit of a rally? The Fed is setting the risk-free rate in the US, and all asset prices are priced around that. And so it is helpful to know what is the trajectory. The economists call it the reaction function. Now, it is not. Think about a world, just for a moment, that would be a Christmas present world, where we could focus on where inflation is going to be, where we could focus where maybe unemployment is going to be, instead of focusing whether Madame Lagarde is sneezing or whether Mr. Powell utters a few words of this sort or that sort. The reason we pay attention to that is because they have the bazooka. But it's not helpful when they try to micromanage everything and anything in the market. Now, they have said that, forward guidance is dead, but of course it's not dead. I mean, you hear that with all the other sound bites that are coming out. They're trying to micromanage what's happening in the market. And I think you summarized it in the introduction. It's going to lead to volatility because there's a lack of consistency in that, and it's not helpful. Now, ultimately, it doesn't matter. We have to deal with it. But a Christmas present, I would not call it. I tend to subscribe to that. And part of the reason is because of the lack of strategy at the Fed. And so now keep in mind that this is the most forecast recession ever. And what that means is that anybody who can prepare has prepared. But of course, those who who cannot, that have unsustainable business model, and there are plenty of those businesses around that were created in the 0% interest environment, those businesses will fail. The question is that enough to turn this economy into recession? And one way to think about it is that historically, the US can deal with one problem, and they can maybe even deal with a problem with the US and China, but it cannot deal with a problem if it is the US, China, and Europe. And so the Chinese are obviously trying to boost their economy. The Europeans, oh my God, what they're doing is pretty sad type of thing. All of that, to me, supports me in my view that this landing is not going to be a soft landing.
JP Morgan expects gold prices to average $2,175 an ounce this year as the Federal Reserve prepares to cut interest rates. Also, can you share your forecast for gold prices this month? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 19.8% of our viewers have subscribed. We aim to reach 5,000 subscribers as soon as possible, and your support could make a big difference. Thank you for being a part of our community.